What's going on, guys? So a lot of you have been losing money just because of the bear market, um, and you're wondering how do you make money in this market? So there's numerous types of ways to make money in this market, and the first one is definitely going to be the most important, and it's to buy hedges for your positions. So say, for example, we have 100 shares of AMD, um, and we're losing money on it. We're losing like 2,800, not a big deal. Um, but for the long term, yeah, we're not really worried. But for the short term, what you can do is trade options. And if you have 100 shares, you can just simply sell like a covered call, maybe 2 weeks out, a week and a half out rather, and then just sell a call option. And basically, what it does is if AMD stays below your strike price, you're gonna be collecting an easy $119 of premium. Um, but what we're basically saying is we're okay selling 100 shares of AMD at our strike price, which is $110. So we're making money not only on the premium, but we're also making money on this the capital appreciation. Because the stock is currently at $102, and if it hits 110, then we're going to be obligated to sell 100 shares at the strike price. So we're making an easy $800 off capital appreciation. And plus, we're making the premium. So that's one way to do it. If you don't have 100 shares of the stock, what you could do is buy a protective put option. So you're most likely going to probably lose money on this put option, but as if the market ends up tanking, you're gonna not lose as much money because you have a put option protecting your assets. So that's the beauty of buying a protected put. Now on this channel, we do like to sell cashier puts, and that's a great way to get into the stock. But also buying put options can also be a great hedge to protect you from losing money. So for example, we could do something like a $95 uh put option, and it's only going to cost you $150. So not that expensive. It's basically buying an insurance. If the stock drops below your strike price, you are going to be making significant amounts of money. But basically, you're protecting your assets, because if you have shares of the stock, you're really protecting your shares. And as we can see, if the stock drops, say it goes all the way to $80, we're gonna be making a ton of money on the put option side, even though we're losing on our shares. So it pretty much cancels out, and it really helps you hedge your portfolio, especially in this bear market. Now you don't have to do this for every single stock. If you just want to do the broader market, you could do just the SPY buy a put option on that, or even do the VXX. If you don't want to trade options, check out ticker symbol VXX, which is basically an inverse ETF. As SPY goes up, VXX goes down, and vice versa. So you could buy shares of this ETF short term, and it even has its name short term. Um, and yeah, if the market ends up continuing dropping, this ETF will go up in value, protecting your portfolio. So those are two ways to protect your portfolio. One with options, well, two with options, and then one with just simple shares. There's tons of inverse ETFs. You can even do T triple Q, or sorry, not T triple Q, SQQQ, which is the inverse of the Nasdaq. Um, and as the market drops, this inverse ETF will, of course, go up in value, and it will help you save your portfolio, especially if you're worried and you can't afford your stocks and assets to drop even further. So that's about it for this video. Thanks for watching.